Canadian real estate is falling off a cliff. Hello, everyone, and welcome back to our Vancouver Life real estate podcast and YouTube channel. A quick note that if you have been listening to us on the podcast, we just finished recording our thank you for hitting episode number 100. That is right. We have been doing this for over 2 years, every single week, and we did a nice little thank you there. So if you watch this on the YouTube only, there's a bonus episode over on our podcast channel. Now, for everybody else here, we are getting into what is happening in Canadian real estate because things are changing so quick. The bottom has almost basically dropped out and things are falling quickly. And this comes, of course, after a 2-year bull run. And so almost no surprise, we knew things were changing, but I don't think anybody saw the change coming this quick. We mentioned on our sort of stats episode last week there about the numbers that are shifting, especially out in the Fraser Valley, where we've seen as much as a $300,000 drop in the median and average prices. More on that as that develops. Before we get into sort of the bad news, if you will, we're going to share a little bit of good news. At least kind of good news. So, interesting stat just hit. Unemployment in Canada just hit the lowest number in recorded history. Ever. There's never been more employed people in Canada, even on a percentage basis. The unemployment rate just hit 5.2%. On top of that, there are currently 826,000 job vacancies. So we've never been in a position we've had this many jobs available and this low of unemployment. It is very strong employment numbers, nationally here. Obviously, if you have a nation this strong with employment, what's the old saying? Well, people go where jobs flow. So if you are living outside of Canada and you're looking into it going, hey, I can pretty much fog a mirror so I can get a job, it's going to make people want to come here. And I think, Ryan, you've got some very interesting numbers about, or that speaks very much to what is happening with interest in living in Canada.
Yeah. If you go to the Canadian immigration website, CIC, you'll one of the biggest articles that they've got currently posted there is there's actually a massive backlog of immigration applications to Canada to the tune of 1.813 million people. 1.8 million plus people. There's backlogged trying to get into Canada. So yes, we have $826,000 job vacancies, but we've got more than enough people to fill them. We're just slow at getting them in here, right? And that sounds oddly familiar in many ways. Seems like anything that hits the government's table all of a sudden takes 9 months before a decision will get made. So anyways, point is, look, we're going to go through some economic data here that's going to, make you feel shaky. It honestly will. But I think macro speaking, looking at the much bigger picture, beyond maybe the next 12 months, there's a huge amount of demand from people around the world to be here and to live here. And these numbers are showcasing that, right? So I really wanted to preface that before we kind of get into wage growth and things like that, because some of these industries are starting to not stagnate because we're still trying to fill jobs and things like that. But if we move on from this a little bit and we start looking, the economy as a whole looks pretty good. Really low unemployment rate. But we're still not seeing a ton of that wage growth that I think we thought we would see, right? 3.4% year over year. That doesn't mean anything when you have inflation that is minus 4% or more, right? So, I mean, if it costs that much more and your wages don't even go up by the amount that the cost is rising by, well, then you're still not better off. It's getting harder, right?
Yeah, exactly.
It,
If wage growth is not outpacing inflation, you're basically making less. So it sounds like you're getting a raise, but everything costs more. So yeah, right now we're sitting at, like Ryan said, about -4 that works out to, which
mhm.
is going to eat away at people's savings and pocketbooks.
Yeah, it's just not really good news. I mean, sure, you're getting paid more, but it costs much more now to do the things that you were hoping to do with the money you were going to get paid more with, right?
Yeah.
So I don't know if it's positive. It's not quite, it's almost, but not quite, right?
Right.
And as inflation continues to persist, it's going to continue to eat away those additional dollars you think you're making, right? Um, businesses right now, they're looking to raise prices faster than they are salaries, right? And that's to the tune of negative 1.7%. So again, it's going to get worse. But companies are looking, look, anytime you print 40% more money supply into a system, you dilute the value of the dollars you're pumping into the system, and therefore you need more dollars to buy the same thing, right? Not to mention you're going to have far more demand for fewer products. So you're going to need even more of those dollars if you have them, right? And that's kind of what we're experiencing right now.
And interestingly, there was one segment, one sort of sector within an industry that has actually shed or lost some jobs in the month of April, and that's what's called the FIRE industries. And that stands for finance, insurance, and real estate. Yes, real estate jobs were shrinking last month. And we're not talking about realtors, we're talking about things like construction workers. Because guess what?
Mhm.
The housing starts number has been dropping for about 4 or 5 months in a row now. So, yes, you're hearing two things: 1.8 million people trying to come into the country, and less homes are being built.
Mhm.
We've been saying this. We've identified this problem for years now. It's been decades, literally, and we're sitting here. Everybody knows the problem. Every headline talks about lack of inventory, and here we are again, and it's still trending the opposite way. Lots of people can come into the country. The other hand of the government saying, "Well, we're not going to build homes for them."
Yeah. And then the partner developers are saying, well, if you're going to raise interest rates on us, we can't make the margins that we need to make, then we're just not going to build, and your inventory issue is going to get worse, right? So we're going to enter back into this, cat and mouse game here of, well, we need you guys to build, and they're going to go, cool. We're not doing it at the rates that we can borrow the money at. So until that changes, until there's enough demand in the marketplace again, then we'll start building again, right? So you're going to have this contraction and this pulling from private and public industry here. And that's we've seen that before, and it's happening again.
And so people that are employed generally, want to have a nice roof over their head. And this is definitely true within the rental segment, where in Toronto, for example, and numbers are likely very similar on this coast here in Vancouver, um, the lease to list ratio, basically the supply and demand ratio, is the highest since 2013, meaning that there are fewer and fewer listings, and the ones that are going up are getting are getting booked up, quicker than historically, all the way back to, gosh, 9 years ago now. And rental rates are up 20% year over year.
Whew.
Yes, we are coming off
Whoa.
of pandemic lows, if you will, but again, a 20% higher rental rate than just 1 year ago. That's pretty significant.
It's
Now,
very, because rental rates are a function of income, right? So have people's incomes gone up 20%? I don't think so.
exactly. Well, yeah, as we know, they're up 3.4%,
That's
not
right.
20.
So, you know, yeah. So, the average person is spending 17% more to rent a place than they were this time last year, or at least
So
since 2013.
that's it. So if is it good or bad if rental rates are increasing? I guess that depends which end of the rental check you're on. But okay,
Yeah.
yeah, if you want to add something there.
Well, I was going to say it can be great if the person renting the place, his salary has gone up by 40%, right? Then sure, they're happy to pay 20% increase. They can. But when you've gone up 3.4%, and at that point you're bleeding, right? You're not going to be able to save any money, and that's where it gets bad.
Yeah, and this is obviously why interest rates are rising. They're trying to battle inflation. They can't see these numbers
Mhm.
increasing this long because it is an unsustainable livelihood for the vast majority of
Yeah.
Canadians.
Yeah.
Okay, so shifting to the quote unquote bad here. And by bad, we mean prices dropping. So again, the vast majority of Canadians are homeowners. Vast majority don't want to see prices go down. But hey, real estate is a cycle. And here we go. We've crested that top and we're on the way down. Thing is, it's like that roller coaster when you come over the top. It's always a little bit steeper than you thought. At least that's what the general sentiment, or sorry, that's what the numbers are showing us today. So let's get into them. Uh, Looking to Toronto as well, because we do like talking about coast to coast here, and they do affect each other, and they are very closely tied here. I'm always amazed by, gosh, when we first got heavily into real estate 5 years ago, it always felt like Toronto was at least sort of 6 to 9 months ahead as far as the cycle, but right now they act almost in unison. Regardless,
Mm.
Toronto home sales down 26% in April. They're about 35% here in Vancouver, but down 40% in the last 2 months. It's a big
Wow.
number. So much
Wow.
so that drop in sales is greater than the global financial crisis in 0809.
Yikes.
And that was a cliff back then. So imagine it being even more intensified than it was in 0809. Overall sales are down 41% year over year, and the detached market is just getting hammered. Sales are down in half. 50% drop in detached sales from last year.
Whoa.
Yeah, these are big numbers, and understandably, inventory is climbing and climbing the fastest it has done so in 12 years, dating back to 2010. Since the beginning of this year, there are 9,000 more active listings in Toronto, nearly doubling the long-term seasonal norm. Now, I guess we'll talk about prices here real quick to give you an example. So in April in Toronto, average prices were down 5% in 1 month.
That's a
Now,
lot.
it's a heck of a lot, and this is looking at the HPI, which is let's just say that lagging indicator, as we touched on a lot in our last episode. That is the fastest April drop, or the largest April drop ever outside of 2020, which was the lockdown when nothing sold anyway. So that doesn't really count. I mean, it counts, but it's not really
Mm-hmm.
apples to apples. So in a
Mm-hmm.
normal non-lockdown season, we just saw the biggest price drop in history for Toronto real estate in the month of April. That's falling off a cliff.
I, I, I don't want to say it, but we've said a couple of times, throughout the last couple of years, that these kinds of numbers, 5% in a month, whether you're going up or down, is not healthy, right? 5% should be across a year for context, right?
Yeah.
This is way too volatile for a housing market. Um, Now I get it. We're coming out of a pandemic. We're trying to return to normal. The Canadian government let it run too hot for too long. So now they're coming up with, big interest rates, big interest rate hikes that are trying to slow this down. Um, it just feels like they could be too heavy, and it could go the other way. We could be in a recession here in 6 to 8 months.
Yeah,
I really believe that.
oh, for sure, absolutely. And what's typical is they act too late and they act too much.
Mm-hmm. Mm-hmm.
Similar, although I will say, actually, no, I'll say that for the end, but because it's very relevant. But let's give a quick update here on our local numbers here, Ryan, because
Yeah, yeah.
everything that we just mentioned previous, that's the hard firm data that's registered by the end of April. And
Mm-hmm.
we have real-time data for here in Vancouver, GVRD. And again, because we've never witnessed such a fast change, we really want to share this with you instead of just waiting, sort of once a month to give you the final stats. So real quick here, GVRD sitting on 9,700 active listings. That's up 10% in just the first 13 days of this month. An additional
Whoa.
900 listings in the first 13 days of May. So what's going on here? This is the fifth straight month of increased inventory. Although, do recognize that's after 7 months of down or decreasing inventory. We're going to cross, 10,000 active units this month for sure. And we haven't seen that many since July of last year, July of 2021. Ryan will always remind us it takes about 15, 16,000 active listings for us to even enter into really a balanced market. But again, it's trending that way quickly.
Oh
And
yeah.
sales, I mean, we're down 42% year over year. And remember, April was like 35%. So the sales
Yeah.
are decreasing. People are really pulling back right now. Buyers are on hold, and this is largely because of the Bank of Canada announcements about the interest rate hike they did and the interest rate hike they're going to do on June the 1st. And then let's talk about that falling off a cliff, because falling off a cliff to everybody means prices. First
Mhm.
2 weeks, first 13 days of May here in GVRD, median price is down 8%, and the average price is down 9% in the first 2 weeks.
Whoa.
Now,
Whoa.
there's still some
Whoa.
desks to sell. We still have 2 weeks of data to come. There's 2 weeks of data to go here, but that's these numbers are real today. And again, when you see all the other metrics pointing this way, we can expect the month to probably land somewhere in and around that 8 to 10% price reduction in median and average sales.
Yeah, I mean, so if your average home is $2 million, which I think it was in the last report, single family that is, um, you're down $190,000, 190 grand, right? That $2 million house is now 1.8, right? A $1.8 million home is now, 165 kind of thing, right? It's people who paid 1.8 and they're sort of like, I wish I had waited. Well, yes and no. You're in at 1.8, but you're also paying 1.5%, probably 1.6% to own that home, right? Person buying it at 1.6 now or 1.65 is going to be paying 3.5% or 4%. So, they're theoretically getting a little bit less home and paying a lot more for it, right? So it's going to be very interesting to see how this rolls out in the next couple of years too, Dan. Like a lot of people got some great deals, but then a lot of people didn't too. So it'll be interesting the next couple of years to see how this pans out. But like anything, real estate's a long-term game, guys. You should not be buying for 1 or 2 years, especially not in these 2 years, if you're not planning to stay there a long time, right? And this is why we're seeing more and more volatile fluctuation in the marketplace. And this not just in real estate, guys. Look at the stock market. It's, we're talking 10% per day in the stock market, right? A lot of people have their wealth there. A lot of people have at least part of their wealth there. So, if disposable income isn't available from the stock market to go into real estate, and vice versa, then, it's not going to move. People are just going to hold, right? And I think that's what people are starting to do now. We're starting to see a significant change in the market. And the first thing people are going to do, they're going to pause and they're going to watch. And that's what's happened. Paused has just taken place. Step one of like 5 to go, right? So this is just the start.
Yeah, you're absolutely right. It's a bit of, I think, shell shock in the marketplace, in the landscape right now. Again, crypto down, 68% in the last month or so. Like, people are kind of really holding on to their wallets a little tighter right now. Most people do not think about making a $1 million or $2 million purchase when their stock portfolio or crypto portfolio is getting hammered, and they're getting a real change in the marketplace kind of sentiment. But this is something that came out just yesterday that I'm quite fascinated by, because we just talked about the fact that typically, the government, the Bank of Canada, they're going to act late, and they often overact or overreact. We definitely saw this essentially with what just happened. Sure, they said they're going to hold rates at the bottom for 3 years. That turned into 2. And then, of course, as things were inflating and getting overheated, and everyone was expecting to see rates increase, they didn't. They waited.
It's
Now,
just transitory, Dan. Don't worry, it's going to work itself
that's
out.
right. Yeah. So,
Oops.
40% over 2 years later, and they're just like, oh yeah, we got to crank this up. But interestingly, so they've done 0.75 hike, right? A 0.25 and a 0.5 hike this year. They've already talked about the
Mm-hmm.
0.5 at the June 1 announcement. But here we go. The data is already out, right? We're seeing the markets across Canada fall and fall rapidly. At least it's a major change. And of course, these things typically don't turn fast, but they kind of are. And so you'd think, oh gosh, this thing's going to crash, to whatever tune you think the word crash means. And then before they go and stimulate again. Because again, their verbiage has been so strong that, yeah, we're going to keep increasing rates aggressively until inflation is under control. But then just yesterday, the deputy governor of the Bank of Canada, Mr. Tony Gravel, made a couple announcements, and the Globe and Mail did an article on this, and I want to read this verbatim because it's quite interesting. He said yesterday, Thursday, May the 12th, how high rates go will depend on how the housing market responds to rising borrowing costs. So they're already paying attention to this, which feels different. Rising interest rates are designed to slow the economy by making borrowing more expensive, obviously. That tends to slow sectors like housing. But this slowing might be amplified this time around because because highly indebted households will face high debt servicing costs and will likely reduce household spending more than they would have otherwise. Okay, what does this tell us? Right out of the gate, they are protecting housing again. They are focusing on it. They've got a closer eye on it than normal. And guys, this is just speaking again, right? They've pulled back the drapes. They've shown their cards. Do you remember when the pandemic hit and everyone freaked out, as understandably did, in March and April? The first thing they did is say nobody has to pay their mortgage if they don't want to. They protected housing first more than anything. Before any curb checks went out, they were telling people who owned homes, don't freak out. We've got you. We're protecting you. And here they are again. They're protecting homeowners. They're protecting Canada's GDP. And now, they prep the market. They prep the landscape by making these announcements to the news in advance of any major change. So already, yes, you've got one person a week ago, Tiff, saying, 2 weeks ago, saying, look, we're raising aggressively until inflation's under control. Housing market's already shifted. Now they're saying, how high these go really depends on what happens in housing. So they're opening up the runway here for them to maybe not raise as aggressively or be able to pull back and stimulate once again. So love it or hate it, that's the reality of Canadian housing, and that's how tied it is into the government of Canada and the Bank of Canada, and play the game accordingly.
I think I could have just, rewritten it for him somewhere to the tune of, hey, guys, sorry, we're a little late to the housing market here. We raised rates pretty decisively and arguably too late. There was already softening in the marketplace, and I didn't mean to scare everybody, but we'll probably be stimulating again soon.
Do you want a job? I've got one for you.
It's just like, I just struggle with this, not consulting with any, industry about where things might be and pretending to play God from, a different province. It just baffles me. But anyways,
yeah,
especially in today's technology, pick up the phone and talk to somebody.
Send an email. I mean, look, market's more volatile than ever, and it's also changing quicker than ever. These cycles have just kind of tightened, and everything just moves
pushed up
so incredibly quick here now. So again, we are very much in uncharted territory here. There's increasing inflation, increasing interest rates, record low unemployment, wage growth, but not at the same pace. It's getting pulled in a number of directions here. I still think they're going to go for the 0.5% in June, but that could very well be it, because by the time that dust settles, let's call it by the end of August, real estate markets can be in a very different place, and they will be pressured to not let it go further. And I think we're going to see some stimulation in the marketplace by rates, or again, like we've talked about, extended amortizations, lower deposits, whatever it's going to be, or down payments rather. We're going to be in a very different place come fall.
So Dan, let me ask you one question. What would be, in your mind, the cure to high prices? Is it
in
interest
the housing
rates?
market?
Yeah, sure. Yeah. Generally speaking,
I'm going to rely on
economically speaking.
economically
What's that?
speaking. Yeah,
Yeah,
economics
economically
101.
speaking. Yeah. How do you bring high prices down?
Supply. To me, it's
That's
supply
one
and
way.
demand. Yep.
Yep. If you can't change supply, then higher prices will eventually bring down high prices because people just get to a point where they won't buy anything. Right.
Hmm.
And that's kind of what happened.
There was
Prices got so high that buyers just said, I'll wait a bit. And then the government was like, oh, it's a little hot. Hey, we should probably start clamping down on this thing. Buyers had already made that decision, right? The government is so involved. Get them back out a little bit. Let the market be the market for a little bit, right? Stimulating like crazy, overstimulating, understimulating. They can't get it right. So get out of it a little bit. Just let the market work itself out a bit here. Let's return to some sort of predictable normalcy instead of all of this volatility, interest rate hikes back and forth and shooting people around. It's just like, it feels too involved.
the CMHC dropped a groundbreaking report on Wednesday here. It was entitled "The CMHC report finds lack of supply the main cause of unaffordable housing." They've cracked it. They've cracked it at the CMHC, Ryan. Supply, supply, supply.
Well, I'm glad they can do math this time round.
Now, obviously, it's never one singular aspect of the market, but again, you know our opinions now, and what we feel would be the main contributing factor to bring down prices.
Yeah, I mean, chronically underbuilt based on our immigration perspectives or targets, right? So, what could you expect? I mean, it's the writing's on the wall. We've got 2 million people, 2 million backlogged trying to get into the country. We're all bragging over here. They've got 900,000 jobs we can't fill. We can fill them. We can certainly fill them. But we just don't have a government that knows how to do it because they need private industry, more private industry, in my opinion, less government agency. But anyways, that's maybe a whole different conversation.
Let's get the housing minister on the pod.
Yeah, or immigration, one of the two.
Oh wow! Imagine both at the same table.
I wonder if they've ever been at one.
That's what I mean. We'd like to introduce you to someone.
Now, okay. Do you know what you're doing? Sorry, I had to.
Open invitation. There you go. Housing minister, immigration. Let's all meet. Okay. That wraps it up for today. That's what's happening in Canadian real estate. It's falling off a cliff. The real question is, how tall is that cliff? And how high will it bounce off the bottom? Thanks as always for watching and listening. Please share this with someone that you think may enjoy it as well. And we look forward to seeing you on the next one. Have an awesome day.